Hi, this is Mike from the HomeHappy Team with your 2026 rate predictions. What we're looking at here is a chart that we've built with a history of 30 years. You can see in the blue is the 5-year fixed rate. The red is the prime rate. Green is the GDP, so it's the strength of the economy basically. And then yellow is inflation. I know that's a lot going on there, but it's important for us to understand kind of where we've been and where we could be going. So in general, what you can see there is a huge drop in GDP back in 2020. That was during COVID, obviously, we're aware of that. Also at that point is when the government spent a ton of money, and that's why you see the bounce back so quickly. That in turn caused inflation, which is why the yellow peaked so high. And since then, inflation has been dropping down. So if you notice the red line, that's what the Bank of Canada uses to try and control the economy. And you can see back in 2007, 2008, the economy started to slow down during the world financial crisis. They dropped prime significantly, and it was fairly low back then. And then as we moved through that period, the economy started to regain before COVID. Obviously, it started to go up a little bit, and then during COVID, obviously, it went way down. So they dropped prime then. So here we are. We're back in 2026. We're sitting at slightly lower levels than we have been. The 5-year fixed is up here in the blue. The prime rate is sitting here. And what does this tell us? It tells us that historically over time, over the last 30 plus years, the average prime rate is 4.54. Well, we're sitting right now at 4.45. So we're very close to the average. We're slightly below. 5-year fixed rates are based not off of prime, but off of the government bond yields and the stock markets and various other things. So they do kind of follow, but they're not exact. And the big takeaway for me is the Bank of Canada has stopped dropping the prime rate, what they call the overnight rate, which corresponds to the prime rate. And they've left some room here. So they've given themselves, they're slightly below average, but basically average. And so they're sitting at that level where they've got some room to drop. And what would they need to drop for? Well, in July, we have CUSMA, which is the North American Free Trade Agreement between the US, Mexico, and Canada. And it's coming due July 1st. And we haven't even started negotiating. Mexico's negotiating, but we're not. So if that agreement doesn't go through, you're going to see a drop, as we've predicted here, of the GDP dropping below positive. It's going to go in negative. So, I mean, we're already kind of clinging to a very low growth period. The only thing that's kind of kept this positive is government spending, and they don't have a lot more room to spend money, so we're already massively in debt. So we expect inflation to sort of stay the same, GDP to drop, and correspondingly the Bank of Canada will have to drop prime going into the later half of the year and going into 27. I know the Bank of Canada and many economists are saying, oh, it's going to stay the same because of jobless, etc. I think the big numbers that are going to be looked at this year are going to be GDP. I don't think inflation is going to be a major threat. And going forward, we just think there's a really good chance of rates going down further, not going up. Of course, all of this is a prediction. Nobody can guarantee anything. But we just want to give you our best forecast that we possibly can and take it into consideration when you're building your plan. And that's what we're here to do, is help you build the best mortgage plan possible. Thanks.